Aneta, you're an economist. You're going to tell me ignore things like food, ignore things like energy. But in the real economy, those things make a difference and put the Fed in a real bind. What's your take?
I'm not going to tell you to ignore it, because I do think while, you could certainly make a case that there's a transitory component to these price pressures. We don't know when that goes away. But even when you go back to the labor market, we think that the labor market and what we're seeing in the wage dynamic, unit labor cost dynamic, explains up to about a percentage point of this elevated inflation. So even if we assume that these bottlenecks are resolved, whenever that might be, presumably in the middle of next year, I just don't think we're going back to 2% inflation. The best case scenario is that maybe we go back to 2.5%, 3% range. That's what wages are telling us at the moment.
What comes next on the inflationary train, Aneta? We've clearly had the effect of the supply bottlenecks. Energy prices are going up. We're certainly seeing that around the world. But energy prices feed into food price inflation. They're a huge input into food price inflation. We are going to see a return of airfares as an expensive item and a rising item. What comes next in terms of keeping this inflationary narrative alive, do you think?
So I think the next 3 to 6 months, we're going to see continued pressures. It's just going to be hot, basically. In the rental market, as you talked about, more pressure there. When you look at market rent indices, they've been rising at a pace that's consistent with, not 0.4 increases in rents and OER and a CPI, but something more consistent with 0.7, maybe even 0.8. So there's more upside there. Core goods inflation. This is the beginning of the holiday shopping season, right? Supply is absolutely constrained, and seasonal demand is going to go much higher by December. So presumably those shortages of products will become even more intense. And then you're absolutely right. I think the travel-related sectors, which are clearly bottoming, could experience even more pressure as well. We just lifted the ban on European tourists a few days ago, and so that should lead to a pickup in demand. So I think the next 3 to 6 months you have to expect more pressure, and I think there's a good chance that we actually see a 5 handle on core CPI as early as December.
Wow. Okay, now that's going to be seriously hot headed into 2022. So the market currently is pricing another 13 basis points of rate hikes by mid-2023. Is the market too complacent in that?
So this is where it gets tricky, I think, with the liftoff, because the Fed obviously has laid out what they call a very stringent test that talks not just about inflation, but the employment situation. And I think we can all agree that we're not quite at maximum employment yet. It's a debate where maximum employment is at the moment. And I think that getting back to the pre-pandemic employment to population ratio is just too ambitious of a goal that the Fed will probably have to abandon at some point. I just don't think they're ready to throw in a towel anytime soon. I think there is another response that the Fed can go toward, and that's just accelerating the taper. I think it's a much more logical response when we're not quite there on the labor market, but clearly there on inflation. We're going to have another CPI report by the December FOMC meeting. It's probably going to be another hot one. And I think there is a growing probability that at that meeting, the Fed accelerates the rate of tapering, maybe even doubles it, which would put them on track to finish by March as opposed to June.